Gold and silver aren't just rallying right now. The price is lying, the spreads are telling the truth, and the crowd that wants to pin this on a single headline is about to get blindsided by what actually moves the next leg. Because this isn't a feel-good inflation story. It isn't a simple dollar down, gold up meme. This is a market structure story hiding inside a macro story. And the payoff is concrete. There are a few levels and a few dates that matter, and if they hold, the path of least resistance changes fast. And if they don't, the shakeout will be violent enough to make even the correct thesis feel wrong. That's where the real pressure starts. Here's what just happened in plain language. Precious metals pushed into fresh territory in a relatively tight window. At the same time, the dollar stopped acting like a one-way wrecking ball. Not collapsing, not screaming higher, just losing clean momentum. And when the dollar loses that crisp trend, the whole market's posture changes. Funding stress changes, hedging changes, the carry trade logic changes. And the most important change is this. When the dollar stops being an easy directional trade, people are forced to look for the next liquid, globally recognized place to park uncertainty. That doesn't mean everyone runs into gold because they're emotional. It means the incentive map changes, and incentives are the invisible hand in a market like this. Now, let me give you the hidden detail early because it reframes everything. You can get a powerful metal surge even without a stampede of fresh speculative longs. You can get it from removal, from closing risk, from forced behavior, from people who were short or underhedged or structurally mispositioned, suddenly needing to buy back exposure into thinning liquidity. That how this stock was why the rally can look like it. Yes, coming out of nowhere on the surface. Because the buying isn't always enthusiasm. Sometimes it's obligation. An obligation doesn't negotiate with your preferred entry price. But that's not the part that matters most. The next detail is what flips the whole setup. When people talk about gold and silver, they obsess over spot price. Spot is the billboard. But the engine is often in the term structure, the spreads, the delivery timing, and the hedging flows. If the front end is getting bid in a way that suggests immediate demand or immediate risk reduction, that's different than a slow grind caused by long-only accumulation. It changes how pullbacks behave. It changes how volatility hits. And it changes the odds of sudden air pockets or sudden vertical candles. In other words, the same direction can have completely different mechanics. And mechanics determine whether you get a gentle trend or a trap-filled battlefield. So let's talk about the dollar losing momentum. Because people get this wrong. A weaker dollar can support metals, yes, but what matters is not the dollar level in isolation. What matters is the dollar's behavior relative to rates, relative to global risk, and relative to how confident the market feels about policy credibility. When the dollar stops trending cleanly, the world stops feeling like it has one safe, high-yield, liquid answer. That's when diversification becomes more than a buzzword. That's when hedges become non-optional. And that's when gold, especially, stops trading like a commodity and starts trading like a balance sheet decision. Think about what's happening under the surface when the dollar's momentum fades. If you're a global institution, your liabilities might be in one currency, your assets in another, your funding costs tied to short-term rates, and your risk models are built on correlations that aren't guaranteed. When the dollar trend gets messy, correlations get messy. And when correlations get messy, hedging demand rises. Not because people suddenly love gold, because risk managers hate uncertainty more than they love returns. That's why these moves can accelerate in waves. And that's also why they can reverse hard without new information. Because the flow is about positioning, not just narrative. Now zoom in on the macro engine that really matters. Real yields versus inflation expectations. Metals don't trade on nominal rates. They trade on the gap between real yields, inflation expectations, and credibility. If real yields are firm and rising, gold often struggles, because you're being paid to hold cash-like assets. If real yields are falling, or if the market believes inflation is sticky relative to what policy can comfortably control, gold's role becomes stronger. But here is the nuance that separates serious observers from headline tourists. Even if real yields are not collapsing, uncertainty about the path of real yields can be enough. Because uncertainty itself increases the value of convexity, assets that can protect you across regimes. Gold is not a coupon. It's not a growth story. It's a regime hedge. And regime hedges get bid when the regime is questioned. Now, silver adds a twist. Silver is both precious metal and industrial input. That S, why it can rip like a monetary asset and then get slammed like a cyclical commodity, sometimes in the same month. It lives in two worlds. That dual identity is a volatility machine. When risk is rising and investors reach for the precious metal basket, silver can get pulled up. When industrial demand is questioned, silver can get yanked down. But if the supply side is constrained, because silver is often produced as a byproduct in other mining operations, then you can get a situation where demand doesn't even have to explode for price to tighten. The supply chain doesn't respond like a light switch. It responds like a slow lever. And slow levers create squeezes when demand surprises. That's where the real pressure starts. Now I want to hit the mechanism that almost never gets explained cleanly. Paper versus physical. That phrase gets abused. People hear it and think it's about villains and heroes. That's not how you build trust. The real concept is simpler and more powerful. Paper markets, futures, forwards, unallocated accounts, or promises. Physical markets, allocated bars, deliverable inventory, real shipments, or constraints. Most of the time, the promise market does a great job of price discovery because confidence is high and delivery stress is low. But when delivery windows, inventory categories, and logistics bottlenecks matter, the promise market can get yanked by the constraint market. Not because of a secret cabal, because of math. Because if the marginal buyer needs metal in a specific form, at a specific location, within a specific time frame, they will pay up. And that paying up shows first in spreads and premiums, not always in spot price. That's the hidden detail. Let's make that tangible. Inventories aren't one number. There's deliverable inventory, the metal that can actually be delivered into the contract specification, and there's non-deliverable inventory, metal that exists but is an AT available for delivery in the way the market demands. There's metal sitting in vaults that's owned and not for sale. There's metal that's pledged, leased, or otherwise tied up. There's metal in transit. There's metal that can't move quickly because refining, assaying, logistics, and compliance all take time. When people say inventories are fine, they often mean some metal exists somewhere. That's not the same as deliverable supply is loose. And in a tight moment, that difference is everything. Because if deliverable supply is tight, front-month spreads can signal stress even when overall holdings look large. And that brings us to term structure. Contango and backwardation aren't academic words. They're signals about convenience yield, financing costs, and immediate scarcity. When the front of the curve is bid relative to the back, it can hint that people value immediate possession more than the promise of later delivery. Not always. Sometimes it's technical. Sometimes it's funding. But when you combine that with other signals, vault movements, ETF flows, central bank behavior, and the way price reacts to dips, you start to see whether the move is fragile or structural. This is where you stop being emotional and start being mechanical. But that's not the part that matters most. The next detail is what flips the whole setup. Options. Options are the shadow market that can turn a normal trend into a launch sequence. When options positioning clusters around certain strikes, especially near expiration, price can start moving like a hedging algorithm, not like a story. Here's the clean explanation. If a lot of call options exist near a certain level and price approaches that level, the dealers who sold those calls often hedge by buying the underlying as price rises. That buying can push price higher, which increases the call sensitivity, which forces more hedging, which pushes price higher again. That reflexive loop is how you get the "it moved too fast" candles. It's not emotion, it's math. And the flip side is just as important. If price drops away from key strikes, hedging flows can reverse and the market can fall faster than the narrative changes. That's why you can be right on the big picture and still get chopped up in the short term. Because if this one level breaks, the math changes. Now let's talk why now. Because timing is never random. Mid-January is not neutral. This is the part of the calendar where positioning resets after year-end, where new allocations start to land, where systematic strategies rebalance, and where liquidity can still be thinner than people assume, especially around key data and policy expectations. The market begins to front-run month-end flows. It begins to anticipate what central banks might signal. It begins to sniff for policy credibility. And with metals, that calendar effect can be brutal. You get moments where liquidity thins, spreads widen, and price jumps in chunks. Then the headlines arrive after. That S, why the market can feel like it, S moving before you, have a reason. The reason is often the calendar plus the positioning, and that's where the real pressure starts. Now let's stack proof the way a skeptic would. Not one argument, not two. We want layers. First layer, the price action itself. When gold can hold gains and build higher lows while the dollar stops trending in a straight line, that's a signal of a bid that doesn't vanish on the first pullback. Second layer, the macro backdrop. Real yields and inflation expectations, creating a zone of uncertainty where hedges are valuable. Third layer, institutional behavior. ETF flows and rebalancing demand that doesn't care about intraday noise. Fourth layer, central bank demand. Structural buying that is not sensitive to your favorite technical level. Fifth layer, market structure. Options hedging that can accelerate moves around expiries and key strikes. Sixth layer, physical constraints. Deliverable inventory and logistics realities that show up in spreads, premiums, and availability patterns. You don't need all six to be screaming at once, but when several are aligned, the odds of follow-through rise. And when they're aligned in an environment where the dollar's momentum is fading, The reflexivity can shock people, but that's not the part that matters most. The next detail is what flips the whole setup. The fifth proof point, market structure, often acts like a magnifying glass. Think about how many participants are not investors at all. They're volatility sellers. They're market makers. They're systematic trend followers. They're CTA models. They're risk parity funds. They're hedgers for industrial users. Their behavior is rule-based, not emotional. When price breaks a level and holds, it can trigger systematic demand. When volatility rises, it can force de-risking. And when correlations shift, it can force rebalancing. These are the flows that make markets feel alive. And when you have that kind of flow environment, the question isn't, is gold a good long-term asset? The question becomes, what is the market forcing participants to do this week? That's the so what. So what does this force people to do right now? If you were short metals because you believed rates would stay higher and the dollar would keep trending and risk would stay orderly, you're suddenly dealing with a market that is less orderly. If your short was sized for calm and now volatility is rising, your margin requirements rise. Your risk model starts yelling. Even if you still believe your thesis, your position size becomes the problem. That's how short covering happens without a dramatic news catalyst. It's not about fear. It's about risk budgets. Enforced covering is the kind of buying that can rip through thin liquidity. That's why the tape can look like it's ignoring fundamentals. It's not ignoring fundamentals. It's repricing risk. Because if this one level breaks, the math changes. Now let's address the counterpoints, because trust comes from acknowledging what could go wrong. The pushback is real. If the dollar regains momentum, say on surprisingly strong data, a shift in rate expectations, or a risk-on surge that pulls capital back toward the highest yielding liquid assets, metals can pull back sharply. If real yields grind higher in a persistent way, gold's opportunity cost rises. If risk markets melt up and volatility collapses, some of the hedging bid can unwind. And silver can be especially vulnerable if industrial demand expectations weaken or if substitution pressures rise. These are not imaginary risks. They are the exact levers that can invalidate the short-term move. But here, wet the discipline. You don't throw out the whole thesis because price wiggles. You watch the mechanism. You watch what changes. Trend signal versus noise. That 1.os, the difference between a trader who survives and a viewer who gets emotionally harvested by volatility. And yes, emotionally harvested is the right phrase, because markets don't just move, they persuade. They use volatility as a weapon. They create the illusion that you were wrong at the exact moment you were most likely to make a bad decision. A sharp pullback after a breakout is not automatically bearish. Often it's a test, a retest, a liquidity grab. The market shakes out late chasers, triggers stops, resets positioning, and then continues. But sometimes the pullback is real. It's the market rejecting the level, breaking structure, and telling you the bid was temporary. Your job is not to predict perfectly. Your job is to avoid being manipulated into maximum regret. So here's a simple psychology shield you can run in real time. First, decide what time frame you're even operating on. Days, weeks, months. Don't let a 5-minute candle hijack a 3-month thesis. Second, identify 1 or 2 key zones. Areas where price must hold to keep the structure intact, not magical lines. Zones. Third, define what would actually change the mechanism. For example, does the dollar regain a cleanup trend? Do real yields rise persistently? Do spreads relax and the front-end tightness fade? Do flows reverse? Fourth, expect violence. Even if the thesis is correct, price can whip around brutally. If you're not prepared for that, you'll self-sabotage. The market doesn't need you to be wrong. It just needs you to be impatient. Now, let's get practical about what to watch next week and the week after, without pretending we have a crystal ball. There are 3 big dials. 1, the dollar's momentum. Not just whether it's up or down, but whether it's trending cleanly or chopping. Choppy dollar often equals rising value of alternative hedges. 2, real yields. Watch the direction and persistence, not the daily noise. If real yields start climbing and staying there, metals can struggle, even if the longer-term case remains intact. 3, the metal's ability to hold the breakout zone on a retest. Retests are common. They're healthy when they hold. They're dangerous when they fail and price can't reclaim the zone. Because if that one level breaks, the math changes. And now I'm going to translate that into 2 scenarios because this is the cleanest way to stay sane. Scenario 1 is the controlled pullback and retest. Price pulls back, volatility spikes, the media declares the move over, and then buyers show up in size at a higher low. Spreads remain relatively firm, dips get absorbed faster, and the market starts to grind higher again. In that scenario, the trend is intact, and the pullback was the market rebalancing positions and clearing weak hands. Your confirmation is not your feelings. Your confirmation is behavior. Do dips get bought quickly? Do we hold key zones? Do we avoid a cascade of lower lows? Scenario 2 is the continuation squeeze. This is where liquidity thins and price doesn't give a polite pullback. It gaps. It jumps. You see candles that look unfair. That can happen if options positioning forces hedging flows, if shorts are trapped, and if macro conditions keep pressuring the dollar's clean trend. In this scenario, the risk is not missing the bottom. The risk is gap risk and whipsaw risk. Moves can extend beyond what feels reasonable and then snap back. That's where people get emotionally destroyed, buying the top and selling the bottom in fast sequence. The way you survive this scenario is by respecting that volatility will be used against you. You don't chase like it's a lottery ticket. You keep your framework, you keep your zones, and you remember that no thesis is a guarantee. Now, I want to anchor this in something very concrete. What forces participants to act? In a controlled retest, the forces are systematic allocation and hedging, steady, patient. In a squeeze, the forces are margin and gamma, urgent, involuntary. Those are different beasts, and you can often see which one you roar in by how price reacts to dips and how it behaves around known liquidity points. If we're squeezing, price barely lets people in, dips are shallow and reversals are sharp. If we're retesting, dips are deeper, but they stabilize and rebounds look like accumulation, not panic. That's the so what that keeps you from getting hypnotized by headlines. Now let's tie in the institutional layer, because it's easy to underestimate how boring flows can move a market. ETF flows don't need drama to matter. A steady bid into an ETF can reduce available float, especially if a lot of holders are sticky. That changes the supply-demand balance in the simplest possible way. Central bank behavior is even more structural. When central banks are net buyers over time, that creates a baseline bid that doesn't care about your favorite oscillator. It doesn't mean price goes straight up. It means pullbacks are met by buyers whose time horizon is not your time horizon. That can change the character of the market. It can turn sell rallies into buy dips. And when that character shift happens at the same time the dollar's momentum fades, you get the kind of rally that keeps surprising people. But that's not the part that matters most. The next detail is what flips the whole setup. The physical layer is the quiet one, but it's the one that can veto the paper story at the wrong moment. If you have stress in deliverable categories, if you have bottlenecks in refining or logistics, if you have regional premiums that don't cool off, that can keep a floor under the front end. Again, you don't need to imagine a grand narrative, it's just supply chain reality. Lead times exist, transportation exists, inventory classification exists, and in tight windows, especially around delivery and settlement timelines, those realities can matter more than a pundit's opinion. If the front end is firm while the story tries to scare people out, pay attention. The market is telling you which side is under pressure. So what's the clean roadmap? Watch the dollar's behavior, not just its level. Watch real yields and their persistence. Watch whether gold and silver defend the breakout zone on any retest. Watch whether pullbacks get bought quickly or whether they unravel into lower lows. And watch the calendar. The calendar is the catalyst more often than people want to admit. Options expiries, month-end positioning, policy deadlines, liquidity pockets. These are the moments where the market forces decisions. And forced decisions create the cleanest moves. But that's also where the traps are set. Let's talk about traps for a second, because if you've been in metals for any length of time, you know the feeling. You get the breakout, you get the excitement, and then you get the rug pull that makes you question everything. That rug pull is often not a refutation. It is the cost of doing business in a market where liquidity can thin and positioning can be crowded. Metals are famous for sharp counter moves. That's why the risk framing matters. Even if the thesis is correct, price can whip around violently. If you can't tolerate that psychologically, you'll make the wrong move at the worst time. The market will convince you the trend is dead right before it resumes, or it will convince you the trend is unstoppable right before it corrects. Your defense is structure and process. Here's a grounded way to think about risk without giving anyone false comfort. There's a difference between being right about direction and being right about path. You can be right that metals are in a bullish regime and still see painful pullbacks. You can be right that the dollar is losing momentum and still see sharp dollar rallies. You can be right that central banks are supportive and still watch speculative flows unwind. That's normal. The question is whether the primary mechanisms remain intact. If they do, pullbacks are opportunities to observe, not reasons to panic. If they don't, if the dollar regains a clean trend, real yields rise persistently, spreads relax, and the market fails to reclaim broken zones, then the setup changes and you adapt. That's not drama, that's discipline. Now, I'll give you one final pull-forward detail, because that's the metric that keeps people honest. Pay attention to whether the market is paying you for immediacy or paying you for patience. In practical terms, that means watching whether front-end tightness persists, whether the market's structure signals urgency, and whether dips get absorbed. If the market is paying for immediacy, you're dealing with a bid that has deadlines, delivery windows, hedging windows, margin windows. Deadlines create squeezes. If the market is paying for patience, you're dealing with a slower allocation story. Still bullish, but less explosive. And the behavior tells you which one you're in before the headlines do. So if you're watching this right now, understand what the setup is asking you to do. It's not asking you to be a hero. It's asking you to be a professional observer. Track the dollar's momentum. Track real yields. Track the retest. Respect the calendar. Expect volatility to be used against you. And Donna T let a single red candle rewrite a multi-layer thesis if the mechanism hasn't T changed. Because that's how markets steal conviction. And the people who win aren't the loudest. They're the ones who can stay calm while the tape tries to bully them into impulse. And if you want a subtle, real CTA that doesn't feel like begging, here it is. Stay with the people who care about mechanisms, not just narratives. The crowd chases headlines. This community watches structure. We watch what forces participants to act. We watch what invalidates the thesis. We watch the levels that change the math. Because in a market like this, belief is cheap, but process is priceless. And over the next week or two, the market is going to offer either a clean retest that confirms the trend or a continuation squeeze that punishes impatience. Either way, the key is the same. Don't get emotionally harvested. Watch the dials. Respect the zones. And remember, price can whip around violently even if the thesis is correct, so your edge is not certainty. Your edge is preparation.